So we have added more value, but not deep value. A lot of these value, if you're looking at the right value index or ETF, there's a lot of earnings momentum characteristics going on there. So these are not deep value like just banks and energy. They also have tech, semis, memory companies, as well as some of the traditional values like banks and energies. So you're just not as concentrated in like the top 5 mega cap growth names if you just stick with growth. So value is a good way to play the broadening of the earnings, broadening of returns, not be so concentrated, and maybe lower the average valuation level in the portfolio. So that was one thing we added, and then we've tried to add more industrials, infrastructure. Again, things that are okay, AI adjacent, could be part of this CapEx boom, but are not the same 5, 6 mega cap growth names that everyone sort of relied on.
Rob, do you want to stay U.S. focused, or do you see opportunity overseas as well?
I mean, opportunities on the valuation side, but for right now, we have really geared to the U.S. because we are a little more insulated in this, energy pricing, situation. So we think, some of the Asia areas got banged up and they're starting to come back. So there's some opportunities there, but we've mostly kind of reallocate a little bit more aggressively to the U.S. for now until we get clear of some of these issues.
Finally, Rob, what about fixed income? Where do I want to put money to work?
Yeah, I mean, I think one of the biggest opportunities in portfolio allocation altogether is investment grade core bonds. You're getting almost 5% yield. That really implies really strong forward returns for fixed income. You can afford to wait through some volatility, even with spreads, pretty tight, right? That 1 to 10 year area of the curve is a pretty good place to be. If we get through this Iran situation, they probably will price a cut back onto the table into the bond market. So you might get a little more upside. So I think core fixed income is looking pretty attractive. Look at the first quarter. Rates went up and you still had flat returns because you're generating so much yield. So you got a lot more cushion. So core fixed income, mortgage backs, very high quality, getting you good yield.